Hello everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, October 4th, 2025. How you doing? I hope you're doing well. I hope you had a good trading week last week. I hope you are having a nice weekend, and I appreciate you coming to my weekend review podcast. Hopefully, today's podcast is going to be helpful and you're going to learn something valuable. The format for today is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week. We're going to look at my open positions. We're going to look at the closed positions. We're going to talk about why I entered the trades, why I exited the trades, any new positions that I entered last week, and we'll talk about how I position sized, how I placed my emergency stops, and how I am going to manage the trade going forward. It's always extremely important that you have a plan whenever you enter a new trade, so you know exactly what you are going to do regardless of what the market does, whether it goes your way, whether it goes against you. It's so important, everybody, that you get yourself a plan, you get yourself a process, and then you execute on that plan. Focus like a laser beam and follow what you are supposed to do. I've traded for over 30 years now, and every day that I trade, every additional day that I trade, the more I realize how important it is that you follow your plan. So I will show you my plan. I will show you my different strategies of what I'm using. But again, we'll go over all my positions, where I entered, why I entered, and how I am going to move, or how I'm going to manage the trade going forward. Hopefully this will give you an idea to help your trading. After we go through all the positions and all the trades, we're going to talk a little bit about trader psychology. The ability to create a plan and follow the plan is the most important skill that you could ever acquire in trading. And so I like to teach it. It's so helpful for me to teach it, and I hope it's going to be helpful for you as well. And then after that, I went through my master watch list last night of all the different stocks that I trade and symbols, and I went through and I have identified 10 potential trades for the upcoming week, for next week, that are getting close to a confluence of signals to where I want to buy. You know, one of the most important advantages that we have as small retail traders is the ability to not always have to be in the market and wait for a proper setup that checks the boxes on everything we want. And what I'm looking for are confluences of, if I'm going long, I'm looking for confluences of signals lining up at the same time. For example, a rejection of an order block, a rejection of a major moving average, a rejection of a 30 RSI level, a bullish MACD divergence, or ideally all of these things happening together. And in my experience, the more you can wait for these type of particular confluences of signals, the much better chance that you will have to have a profitable trade. And the nice thing about being patient and waiting for these signals is that even if you're wrong, you have a high probability of being wrong very small, with a high probability of having a large gain if you are correct. And that's really what trading is, a good risk to reward ratio. Being patient, waiting for a confluence of signals. If you're right, having a process to stay in. If you're wrong, getting out quickly and waiting for a new setup. So that's what we're going to do today. I hope it's going to be helpful. If it is, I'd appreciate if you could hit the thumbs up button. Really helps to keep the channel around, lets YouTube know that there's some valuable content here. So first of all, let's run this U.S. legal disclaimer, get that out of the way, and then we'll come back and we'll get started. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started with the current open positions that I have. This is Berkshire Hathaway, BRKB. I did get long BRKB here on the 10th of September. So first of all, why did I take the trade here? Well, this is a confluence of an order block and a rejection of a major moving average. This is one of my absolute favorite setups, and this is what I was just talking about, being patient and waiting for these. So let's first talk about the order block. You see this green block here. Why did I draw this green block here? Well, an order block, this is the pattern that I need to be able to identify an order block. If we go back here, you can see on the 21st of August, we had a swing low. A swing low just means you have a higher low to the left and you have a higher low to the right, okay? So we have a swing low, followed by a swing high. Swing high is the opposite. You have a lower high to the left and a lower high to the right. So we have a swing low, we have a swing high. Now here we have another swing low, but this swing low is lower than the first swing low. So as soon as this happens, now you have the potential to change market structure to the upside if after that second lower swing low takes out that swing high. So let's just make it simple. Swing low, swing high, lower swing low, and then we went above this swing high. As soon as this happens, now you have changed market structure into a new uptrend. And as soon as you change market structure into a new uptrend, the lowest closing bar before market structure change becomes your order block. So now this is the lowest closing bar, this blue one, before market structure change. So therefore the high and the low of this bar moved into the future becomes the order block. So if and when in the future the price comes back into the order block, that is a buyable area. Now there's a few ways that I do this. A rejection of the high of the order block. You can see this bar here, the entry bar that I took, did reject the high of the order block. And what do I mean by rejection of the high of the order block? It just means that it went into the order block during the day, but it closed back above it. That is a rejection of the order block. So again, the reason I took the trade here was because number one, we rejected the high of the order block, and number two, we rejected the 200-day moving average, which is the black line here. So these are two different strategies lining up at once. A rejection of the 200-day moving average just by itself is a legitimate entry signal. That's a deep dip buy signal. But the order block signal, the rejection of the high of the order block, is also a legitimate signal. But you see how both signals happened on the same day. So I entered here on the 10th of September at 489.46 because of the rejection of the high of the order block and the rejection of the 200-day moving average. So first thing, most important is as soon as I have my entry here, I need to decide how many shares I'm going to buy, right? And the way I do this, I have a very simple formula. I take 1% of my trading account, and then I divide it by the value of the 2ATR. 2ATR just means it's 2 times the average range of this. And this is what I use to measure volatility. If this is very high number, then that means that the movement was very high. And therefore, I'm going to buy fewer shares. If it's a low number, it's going to have, just the formula is going to have me buy more shares. So this is what I do. Let's just say I have $100,000. 1% is 1,000. And this works if it's a million, 1% would be 10,000. If you have 50,000, 1% would be 500. So let's just say we have $100,000 times 1% is $1,000. I then divide that by the value of the 2 ATR. The value of the 2 ATR is 1184 divided by 1184. So based upon this formula, it tells me to buy 84.45 shares. So I'll just buy 84 shares. So I have the rejection of the high of the order block. I have the rejection of the 200-day moving average. I entered at 489.46 and I buy 84 shares. So the very first thing I do then is I take my entry price minus 1184 and I place my emergency stop. This is the first stop. I place 2 stops. So I place this exactly the value of the 2 ATR below. So in the future, if I have 84 shares and it goes down 1184, how much am I going to lose? I'm going to lose 1% of my account because we just did the math, right? So that's my worst case, generally my worst case scenario on this trade. Now, the good news is that this only happens about 5% of the time. The other 95% of the time, if I have a loss on the trade, it is going to be because of my end of bar stop, not my emergency stop. And so what is my end of bar stop on this trade? Simply a close below this 200-day moving average, right? I want to give myself a very good starting risk to reward ratio. If the next day it had closed below the 200, I would have gotten out. Even by a penny, I would have gotten out. Okay, so yes, I would have had a loss, but it would have been a very, very small loss. Remember, the 2 ATR is basically my worst case scenario, right? 1% of my account I would lose. But my end of bar stop, 95% of the time, it's going to be a much smaller loss than my emergency stop. Okay, so we have the rejection of the 200-day moving average. We have the rejection of the order block. I position size. I place my emergency stop 2 ATRs below. The next thing I do is I take the entry price plus the value of the 1.5 ATR. So here the 1.5 ATR is 1.88. I take my entry price and add above it 888 or $8.88. I just, whatever my entry price is and whatever the 1.5 is, I place a line up here. This is my trailing stop level. This just means if in the future I get up to 1.5 ATRs above my entry, now I go into trailing stop mode. It doesn't mean that I do anything. It just means that if I touch that, now I go into trailing stop mode. And so, in trading, if you enter and it starts moving your way nicely, then you want to tighten up your stops, right? So you don't give everything back. And so going into trailing stop mode does that, because if I get to trailing stop mode, and then in the future, if I have a close below a previous bar's low, I will exit half of the remaining shares that I have. And this has the effect of tightening everything up. Make sense? Okay, so everything I've talked about so far, as far as having an emergency stop, having a end of bar stop, going into trailing stop mode, these are all defensive moves. Or in other words, if the price goes against me, I have to take some action. But I always like to play offense in my trading as well, not just defense. And the way that I do that is I take partial profits each day if the price moves a certain distance from the closing price. So I'm in this trade right now, and I'll show you how I do this. This will be for Monday. Okay, the closing price is $498.75. Okay, that's pretty easy. Closing price $498.55. Now I have a value of the 0.45 ATR as well. And right now the value of the 0.45 ATR is $2.66. So all I do, and I redo this every single day, I take the closing price plus the value of the 0.45, which is 266. I add those together, 266. My first profit target for Monday is 501.44. Now, how much do I sell if it gets there on Monday? 10% of however many shares I have going into the day. If I go into the day with 10 shares, 10% is 1 share. So I would sell 1 share at 501.41. I just place the limit order. Now, I always place 3 profit targets each day. So the first profit target was the closing price, 498.75, plus the value of the 0.45. 501.41 is my first. Then I take the first profit target, 501.41. I added the 266 to it again, plus 266. My second profit target, 504.07. That's my second. And I also put in a limit order then for 10% of however many shares I went into the day with. And I do it one more time. I take the second profit target, 504.07, plus 2.66. My third profit target, 506.73. Okay, so I always place 3 limit orders into the next day based upon the closing price plus the 0.45 ATR, and I do that 3 times. If the market is down the next day, I don't hit any profit targets. If the market's up pretty decently, maybe I hit 1. If it's up really nice, maybe I hit 2. If it's really up, maybe I hit 3. But I want to take advantage of selling into the strength. If the market's giving me something, I want to take a little bit. And so that's how I look at trading. I play offense and defense. Things going against me, I take actions. Things going my way, I also take action. And I'm a big fan of this. I think there's a lot of advantages of taking partial profits. It reduces your position size. As you reduce your position size, you reduce the position heat or stress of the trade. And it's more likely than not to help you stay on track as you're reducing and you're reducing and you're reducing to stay on track with following your position. All right. So let's kind of restart here now that we've kind of got the basics. Again, we have an order block. We have a 200-day moving average. On the day that I entered at 486.49, the signals were we had intraday rejection of the high of the order block. We had an intraday rejection of the 200-day moving average. I positioned size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average. I placed my 1.5 ATR trailing stop level, 1.5 ATRs above my entry, and off we go. The next day, up nicely, right out of the bat. That's always nice. I hit multiple profit targets on this day up. So already I have sold some into this strength. Okay. Next day, down, no profit targets. Next day, down again. Next day, down again. And we come here and we retest the 200. But we tested it, but we closed above it. So I stayed in the trade. The next day, up, partial profit. Next day, another retest of the 200, but we stayed above. Next day, another retest of the 200. We stayed above, another retest. And then the next day we go up. Again, profit targets. Next day up a little. Next day down a little. Next day up. Nice. Hit more profit targets. Now, here on the 23rd, do you see how we touched the trailing stop level? So this means that now in the future, if I have a close below a previous bar's low, I am going to get out of half. So here we go up, profit target. Here we went below the low of the previous bar, but we closed above it, kept me in the trade. Here on the 30th, nice big bar up where I hit more profit targets. Next day down, no profit targets. Thursday down, but you can see it just barely closed above the low. That kept me in the trade. And then on Friday, up, and at one point up a lot. And so I hit multiple profit targets on this trade. So currently, I'm still in this position. Of course, I've taken partial profits when it's given to me, but the remaining shares that I have on this trade up 1.87%. So not too bad. All right, let's go to the next trade. Okay, so Bitcoin, BITO. I entered this trade. This is a different type. This is a different strategy. I trade 7 different strategies. This one is called an abandoned baby. I know it's kind of a crazy name for the strategy, but I have a free YouTube video, or I have a video on YouTube that's free on my YouTube channel. Go check it out, and it talks about abandoned babies and island reversals. And this will give you more in-depth information about exactly how I take these trades, what they are. But essentially, you can see this bar here with the green outline. This is the abandoned baby. So what makes this an abandoned baby? The day before the green box here, we gapped down. So overnight, for whatever reason, the news, the sentiment for Bitcoin was bearish because we opened down. Okay. But if you have a gap down and then the very next day you have a gap up, you had a very quick change in sentiment. You had a bearish sentiment followed very, very quickly by a bullish sentiment, leaving this bar by itself. So if you have a gap down, and then the very next day you have a gap up, this is an indication that sentiment has changed very quickly. And in my experience using abandoned babies, this is telling me that in the future, the price should be higher. Okay. So what I like to do is after you have a gap down followed by a gap up, a lot of the time the price will come down and retest the top of that baby. And you can see exactly what it did. It came back, it tested the top of that baby, and I got long here at 1923. Now, I just got done telling you about setting emergency stops and end of bar stops and taking partial profits. And that is the process that I follow on all of my trades except for an abandoned baby. On abandoned baby, I make it very simple. I set my 2 ATR stop as always, right? 1% of my capital divided by the 2 ATR. Here's my emergency stop, 2 ATRs below. But to the upside on this one, I make it simple and I place a 4 ATR profit target. So if I'm right, I'm going to make twice as much as if I'm wrong. So I take the trade, I set the trade, and I forget it. I'm either going to lose 2 ATRs or I'm going to make 4 ATRs. And that's proper trading when you have a risk to reward ratio where your reward is twice what you're risking, right? And so in my experience on these abandoned babies, I hit my 4 ATR profit targets way more than 50% than when I lose with 2. So it's, in my experience, about 70% of the time, I make twice as much as when I lose. 30% of the time, I lose two ATRs. About 70% of the time, I make 4 ATRs. That's pretty good, right? That's pretty good. So you can see it started off nicely, good, then came down, but it did not get to my 2 ATR stop yet. And then all of last week, we have gone up. So you can see this is my profit target up here, 2151, the 4 ATRs. Down here, the stop loss, 1810 is the 2 ATR stop. And so this trade is still in progress. And eventually, I'm either going to hit this or hit this. I think you'd agree. Eventually, I'm going to hit one of those. And so far, this particular trade up nicely, up 5.32%. All right, next one is CRM. I shorted CRM with an order block. Order blocks can be bullish or they can be bearish. Well, this one is bullish. So you see the red order block here. So let's talk about what a bearish order block is. Remember now, a bullish order block was a swing low, followed by a swing high, followed by a lower swing low, and then market structure change to the upside. Well, this is the opposite, so we need to do everything opposite. It's opposite day, right? We have a swing high, followed by a swing low, followed by another swing high that's higher than the first swing high, and then we go down and take out that swing low. As soon as that happens, we have now changed market structure to the downside. And if I change market structure to the downside, I want to look to short rallies back into the bearish order block. So, like I showed you with, what was it? With Berkshire, I also use a moving average in this particular trade. You see the gray line? The gray line is the 50-day moving average. So that 50-day moving average is living inside this bearish order block. Now, I took the trade here on the 9th of September because it rejected the 50-day moving average inside an already bearish area. So I got short here 252.04. Now, because I'm short, I do everything opposite. I position size the same way, 1% divided by the 2 ATRs. I place my emergency stop 2 ATRs above, but my end of bar stop is simply going to be a close above this 50-day. Remember, I want to keep those end of day stops as close to my entry as possible. So if the next day it had closed above this 50, I simply would have been out of the trade, right? So I entered here 252.80, emergency stop 2 ATRs above, end of bar stop close above the 50-day moving average. I placed my 1.5 trailing stop level below me now because I'm short, and I also take partial profits each day, the partial 0.45 profits each day if it moves my way. So enter here 252.04, the next day, boom, big down. Okay, a lot of things happen on this day. I hit 3 profit targets to the downside, right? So I've already reduced my position and taken profits in the move down. And also, in the very next day, I got to trailing stop level. So now, because I'm short, trailing stop level means if in the future I have a close above a previous bar's high, I'm going to get out of half of my position. So the next day was up, but did not go above the previous bar's high. The next day, down again. I took more partial profits. The next day, down a little, but not enough to take partial profits. The next day here, down. I took more profit targets into that day. And then here, the very next day on the 17th is our first close above a previous bar's high after reaching trailing stop level. What do? I cover, because I'm short, half of my position, okay? So I covered half of my position here for a gain of 4.04%. And then we had 3 days that just went against me, went up, went up, went up, went up. On this day here, you can see it went up quite a bit, but it did not close above the 50-day moving average, so therefore I didn't get out of the trade, right? The next day starts up, went above the 50-day. I thought, oh, I may have to get out of this trade if it closes above, but it reversed, came down. I hit multiple profit targets to the downside, and I'm still in the trade. Next day up, next day down, more profit targets, then a couple days up, and then here on the 30th, down big, multiple profit targets again, right? So again, this particular trade at the moment, the remaining shares that I have on this trade are up 4.86%. But going forward, next week, if it closes above the 50, I will get out of the trade. If it continues down, I'll continue to take partial profits. If we get to right here, the RSI level is 45.60. If we start getting into like a 35 RSI level, then my strategy and my rules will tell me if we have a close above the 5 EMA, I will just exit the trade completely. But we're not there yet, so but yeah, this has been a nice short trade. First half gain of 4.04%. The remaining shares I have up 4.86%. So good, I think, example of showing you the power of order blocks, whether they are bearish or bullish, and this one was bearish. All right, let's go to Coca-Cola. All right, so I'm going to introduce a little something different on this particular trade. I haven't talked much about this, but we'll talk about it today. So here's Coca-Cola. All right, now you can see we have a big green box here. So what does that mean? That means that there was an order block somewhere in the past. This is a very wide order block. So where was the order block? Well, the order block was here, 319.25. We have a swing low, followed by a swing high, followed by a swing low, market structure change. This makes this particular box here, this is the lowest closing bar before market structure change. Oh, sorry, I messed up that market structure change. Here's the swing low, Here's the swing high. Here's the lower swing low. Here's the market structure change. So the lowest closing bar before the market structure change is the high and the low of this bar on the 7th, but it's a big, wide order block. Lots of things going on in this order block. So I took the trade here on the 29th of September. Now, I can buy with the rejection of the high of the order block. I can buy with the rejection of the low of the order block. I can buy with the rejection of a major, or really any moving average inside the order block. But you can see on the day that I bought here, 6603, there were no moving averages. We didn't go under 30 RSI, over 30 RSI. So why did I take the trade? Well, let's start back here on the 20th. You can see on the 20th here, we have a swing low, right? You can see here on the 31st of July, we have another swing low. Now, if you connect swing lows with a trend line, here's this swing low, here's a lower swing low. Do you see how I connect this trend line and draw the line from this swing low to this swing low and then out into the future? When you do that, when you have a swing low and another swing low, and you draw the line out into the future, very often when the price comes to that kind of megaphone trend line, that is where it is going to, if you have a rejection of that trend line, that can be an entry point if it occurs inside of the order block. So I connected the bottoms, drove it out into the future. Here on the 29th, you can see we rejected that trend line. In other words, we were below it and we closed above it. That was my entry. In addition to that, we created a V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. Okay, that adds bonus points to the trade. So this is why. Connected the line, rejected the trend line drawn out to the future, rejected it plus the V1. That was my entry. So I entered 6603. I placed my emergency stop as always, 2 ATRs below. My end of bar stop on this is simply going to be a close below this trend line. We've broken this trend line. And so therefore, if it's going to move up, it should respect this trend line and not go below it. Does that make sense? All right, so V1, rejection of the trend line inside the order block, got long 6603, emergency stop 2 ATRs below, end of our stop closed below the trend line, 1.5 ATRs above is my trailing stop level, and off we go. Next day up for a profit target. Next day up again, but not enough for a profit target. Thursday down, Friday up, enough for a profit target. I have not got to trailing stop level, so it hasn't done a whole lot yet, but it is positive so far, and it is up 0.87% so far on the trade. But like again, like I mentioned before, I haven't really talked about these connecting the bottoms with these trend lines, but when we get in today, when we get into potential trades for next week, I do have a couple where we're drawing the trend lines, the bottom, connecting the trend lines into the future inside the order blocks. So I want to highlight this here on this particular trade because for next week we have something similar. All right, so Coca-Cola doing okay, nothing great, but a good example of a rejection of an extended trend line and why we got in up 0.87%. Okay, so just to review, Berkshire remaining shares on the open positions, Berkshire up 1.87, Bitcoin up 5.32, CRM remaining shares on the short up 4.86, and Coca-Cola KO up 0.87. Okay, let's go to the closing trades or the trades that I closed last week. And let's start with Netflix. So I got into Netflix all the way back here on the 7th of August. Why? Well, because we rejected this order block. This is an order block from the past. On the day that I entered, you can see we were below. There's 3 boxes here. I'm talking about the first box. We closed below the green box. We closed back in it. That was my entry. I got long 1181 position size, placed my emergency stop 2 ATRs below, placed my trailing stop level 1.5 ATRs above. Next day, up. Profit targets, right away got to trailing stop level. We continue up, and then here on the 13th, we have our first close below a previous bar's low. After reaching trailing stop level, I sold half of everything for a gain of 1.94%. And then next day up, profit targets, we come back down. I had another profit target here. We kind of came down. Then we had a nice few days, nice couple up days where I continue to sell into this strength, right? Here we come down. Here we have a little bit of rally where, again, I'm selling shares into this strength, thankfully. And then we have just come down. You know, there was some bad news last week for Netflix regarding Elon Musk and, you know, this kind of stuff. And so that kind of made Netflix go down, obviously. But I got out of Netflix on the 1st of October. Why? Because it closed below the low of the order block. It closed below my end of our stop. And so on the remaining shares, I took a loss of 0.94%. But this is a good example, everybody, and a good teaching moment that, yes, the remaining shares, I lost 0.94%. That is true. But overall, super positive on the trade. Why? Because I had a process where I took partial profits when the market gave them to me. I exited half of the positions here for a gain of 1.94%. And then every time we were up, I sold into that strength here and here and here, right? So it's a good example to show you of why it's important that I sell partial profits into strength, and why it's important that when I go into trailing stop mode, it tightened everything up. So yes, the remaining shares, loss of 0.94%, but really overall, this was a positive trade. Okay, so that's Netflix. McDonald's. All right, McDonald's, really good trade setup, ended up being a loss, but the loss was small, and that's what's important. So green box, order block, right? Swing low, followed by a swing high, followed by a lower swing low, followed by market structure change, defines the order block. I bring the order block into the future. Look what's living inside the order block, 200-day moving average. So I got long McDonald's on the 18th of September at $301.07. I position size as I'm supposed to. I placed my emergency stop 2 ATRs below. And off we go. We had some days where it was up, took some partial profits, but here on the 2nd of October, we closed below the 200-day moving average. That was my line in the sand, right? So it was a very small loss, which is fine, a loss of 0.5%. But again, was it totally a loss of 0.5? No, because I took partial profits on the days that it was up. But listen, this is a really good setup. Bullish order block, rejection of a major moving average, perfect. But it doesn't, no matter how perfect the setup is, it doesn't mean it has to be profitable. But it was a loss, but it was a very small loss, and I can always get back in. Technically, I could have gotten back in this on Friday. I did not, but technically I could have, right? Because it now regained and closed above the 200-day moving average. So an example of a really good setup that didn't work, but, you know, other than having a profit, this is about the best I could have done with a very, very, very small loss, because they don't always work. So a loss of 0.5%. WES. All right, this was a crazy trade, and this is a really great example of why it's important for me to take partial profits. So WES, you can see we have this green order block, the higher order block, into the future. Now, I entered WES on the 23rd of September at 38.56. Why? Two reasons. One, we rejected the high of the order block. And on this particular day, we also had a close over the 20-day moving average, which is the blue line. I don't use that a lot, but in this particular case, I did. So with the rejection of the high of the order block, I don't want to put my stop at a close below the low of the order block. That is way too far below. So I'm using the 20-day moving average as my line in the sand. But again, two things here: close under, close over the 20, and a rejection of the high of the order block. In other words, we closed above. So I entered 38.56. Okay? Now, the next day took off like a rocket ship, and I hit multiple profit targets. I know I hit two, perhaps I hit three. The next day, up again, not enough for a profit target. The next day, boom, another huge up bar where I sold into that strength. So I believe I hit probably 5 profit targets on these 3 days up. Now, on this particular day, we got to 65 RSI. Whenever I get to a 65 RSI on a trade, then in the future, if we close below the 5 EMA, I'm going to get out of the trade. And that's exactly what happened. Huge up followed by huge down. And so the remaining shares on this trade, it closed below the 5 EMA and it closed below my entry for a loss of 0.34%. But actually, I made money on this trade because I had so many profit targets. I mean, I sold 40% of this trade into that strength. You see what I mean? But then the next day reversed strongly and took a loss on the remaining shares of 0.34%. But all in all, still up on the trade. You see how important that is to take those, to take the profits when you have them for this exact reason. All right. Okay. Okay, so those are the dailies or the closed out trades. Netflix loss of 0.94%, McDonald's loss of 0.5%, and WES loss of 0.31%. But let's look at the open trades with some larger gains, and then the closed trades. I'm out pretty quick, and that's proper trading. If you have a trade that goes your way and you're in a long time, great. Let it grow, let it do its thing. But when you're wrong, you get out quickly. And these 3 trades, I was out quickly, right? As soon as they hit my stop, I'm out for small, reasonable losses. Okay, let's go to the weekly trades. I trade on both on the daily time frames and the weekly time frames. And now weekly bars close on Friday, so I make my trading decisions on Friday. And this was a really good week for my XLV trade on the weekly time frames. Again, these are weekly bars. So if you have been so I entered XLV on the 8th of August at 130.70. But if you've been watching this podcast for any length of time, I started talking about XLV all the way back here. And I said, look, we have an order block way down here. We have a 300-week moving average. This is the orange line here. And I was patient for many, many weeks for the price to come to where I wanted it. I talked about XLV week after week after week after week. I said, if and only if it gets down to where I want it to, a rejection of the 300 or rejection of the order block, the top of the order block, or both, I'll take the trade. And look, I was patient. I waited for it to do exactly what I wanted it to do. it rejected the 300-week moving average. It clearly closed above the top of the order block, so it rejected the high of the order block. So I got long here 130.07. I position size. I place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the 300-day moving average. I place my 1.5 ATR trailing stop level above. And look, the next week took off like a rocket ship, hit multiple profit targets. Next week up again, another profit target, got the trailing stop level. Then for about a month, we went sideways. The week before last, we closed below the previous bar's low after reaching trailing stop levels. What do my rules tell me to do? I take half. So I took half here for a gain of 3.99%. But the great thing about selling half, everybody, it's one of the only win-win situations in trading, is that if you sell half and it goes down, you're glad you sold half. If you sell half and it goes up, you are glad that you still have half. And this is exactly the situation that happened with this trade, because this week, up, monster move up. And again, I sold, I had multiple profit targets into this strength. All right, we're at 60.73 RSI. If next week we get up to 65 RSI or higher, then I will use the 5 EMA as my trailing stop to get out of the rest of the trade. But the remaining shares I have on XLV doing very well, up 10.13%. The main takeaway here is being patient, waiting for the price to come to where you want it to do, where you want it to be. And that's exactly what I did. And I waited months for that to happen. So there's a good lesson in that. But yeah, very nice remaining shares up 10.13%. UUP is a weekly trade on the dollar. This is a good example of a combination of confluences. I got long 7.11.25 at 27.21. What were the signals? There are two of them. Close under, close over the 200. That is a deep dip buy signal. And we also rejected the high of the order block. So I got long 27.21. I position size. I placed my emergency stop 2 ATRs below. Placed my trailing stop level 1.5 ATRs above. Next week, we moved up, profit target. Next week, down, but it held the stop. It did not close below the 200. Next week, up strong, sold into that strength, and now I'm also in trailing stop mode. Next week down, next week we have our first close under a previous bar's low after reaching trailing stop level. I sold half of the remaining shares for position at 0.51%. Not a big gain, I know, but this is the dollar. You don't get the kind of moves. And then we've basically moved sideways for weeks. Here on the 19th, we was a big down, but it recovered, closed back above, kept me in the trade because it closed above the 200-day moving average. The next week was up, where I was able to take a profit target into that strength, and the remaining shares up 1.02%. All right, next TLT. I've been in this trade since January, if you can believe it. So I'm not usually in trades this long, but my strategy and my process has told me to stay in. So I entered all the way back here on the 17th of January. Why? We rejected the high of the order block and we had a V1. I entered 87.20. I placed my emergency stop 2 ATRs below. I placed my trailing stop 1.5 ATRs above. And then we started to move up right away after that trade. I took some profit targets here. I certainly took some multiple profit targets into this move here. I'm at trailing stop level. We moved sideways for about a month. And then we have another big up move, which fortunately I sold into that strength. And then we had this huge big bar down on 411 where we closed below the previous bar's low after reaching trailing stop level. I had to get out of half of the shares for a loss of 0.58%. Now, all in all, am I still up on the trade at this point? I am, because I fortunately sold into that strength. And then we move up. I take profits. We're down for a month. remember, if I close below this order block, I'm out of the trade, but it's never been able to do that. And then we start moving our way up here. There was a couple profit targets, and we moved down for a couple weeks, and then we move up profit targets, down sideways. And then we had the big week up where I hit multiple profit targets. Again, the next week continued up into strength. I took multiple profit targets. And so the remaining shares on this particular trade up 2.37%, which is nice. But all in all, this has actually been a pretty good trade because this TLT pays a dividend for about, it's a little over 4% for the year, but it pays it monthly. So every single month I've been paid a dividend for about 10 months, and I'm profitable on the trade as well. So pretty interesting example of a long-term trade here. Normally not in trades this long, but just one of those situations that kept me in the trade. But all in all, the remaining shares up 2.37%, plus all the dividends and the profit targets at higher prices. Okay, last but not least, Amazon is a short position that I took based upon a bearish order block. So again, what's a bearish order block? A swing high, followed by a swing low, followed by a higher swing high, followed by market structure change by taking out that swing low. As soon as that happens, the highest bar close before market structure becomes my bearish order block, the high and the low. I move that into the future. Now, this particular order block does not have any major moving averages in it. So what I did is I created my own level inside that bearish order block. Just like I was showing you with connecting the bottoms and creating the trend line. That's one way to do it, and I'm going to show you some more examples of that. But the other way to do this is look at this bar here on the 7th of February. Big down bar. If you have a big down bar, very often, if you rally back to halfway of that big down, so here's the high, here's the low, let's go halfway, that's 233.70. I took halfway of that big down bar because in general, that's going to be a resistance level. I brought it into the future, and again, that inherent resistance level is inside a bearish order block, which is, that's two bearish things going on. And so here on the 15th, we rejected that midway point of the big down bar of 23.70. Again, inside a bearish order block. So I got short 230.90. I position size, I placed my emergency stop 2 ATRs above. My end of bar stop is very close. It's just a close above the high of this halfway mark inside the bearish order block, and I placed my trailing stop level 1.5 ATRs below. Okay, for a couple weeks, didn't do anything. Next week, got above my end of bar stop level, but it closed below. It kept me in the trade. The next week, up again, but it closed below level. Kept me in the trade. Next week, kind of a nothing burger. Next week, or not last week, but the week before, down, finally broke my way, and I took partial profits on that move. And this week, down a little, but not much. All right. So this particular trade here on Amazon, the remaining shares that I have up 5.24%. So just as a recap on the weeklies, remaining shares on the XLV long up 10.13%. The remaining shares on the dollar UUP up 1.02%. The remaining shares on TLT on the long up 2.37%. And the remaining shares on the Amazon weekly short up 5.24%. So anyway, I hope that was helpful, everybody, so you can kind of see how I get into trades, what I'm looking for, how I manage them, how I take partial profits, and how I exit them, whether it's a gain or a loss. All right. So before we move on to the potential trades for next week, let's spend a few minutes, talk a little bit about trader psychology, and hopefully that will be helpful as well. So let's take a look at this. Okay, this comes from my good friend Steve Burns. You can follow Steve at @SJosephBurns over on X. Steve is a great trader. great coach, great author. I think he's written 44 books on trading. Can you believe that? Second of all the people in the world, he's number 2 right now with 44 books, but I'm sure he will become the number 1 author, I'm sure, because he writes books all the time. He's a great person, great trader, great author. Check out his books on Amazon. They're worth reading every single one. I would suggest Moving Averages 101. I was lucky enough to write the foreword on that book. It's a great book. And, what I'm showing you here today is partially what I have learned from Steve with the major moving averages. So check out that book, Trading 101. Moving Averages 101, excuse me. You can find them all on Amazon. So let's see what Steve has to say here today. Profitable traders sound boring because they're patient and they keep it simple. Unprofitable traders sound exciting because they complicate everything and are always extremely bearish or bullish. One makes money, one doesn't. This is true, folks. Again, I've traded for over 30 years. Every day that goes by reinforces the fact to me that to make money, you need to keep it simple. I know a lot of traders, and I follow what they're doing. They call me, what do you think about this? What do you think about that? And the common denominator is I feel like they try to over complicate things. They like the action. They like the fast. Oh, I'll do this. I'll do this. I'll put a hedge. And I'm just telling you, listen, if you're starting out trading right now, one of the best things you can learn, keep it simple. Keep it simple. Be patient. Wait for a good confluence of signals. Get yourself a good risk to reward ratio, position size, and follow the rules. But for some reason, a lot of traders want to overcomplicate things. And the more you overcomplicate things, the more mistakes you make. The more mistakes you make, the more it's going to cost you money. Even if it's a little here and a little there, that adds up to a lot of money at the end of the year. So let's read it one more time. Profitable traders sound boring because they're patient and they keep it simple. Unprofitable traders sound exciting because they complicate everything and they're always extremely bearish or extremely bullish. One makes money and one doesn't. And this part about they're extremely bearish or extremely bullish is so true. I know people that are always extremely bullish. I know people that are always extremely bearish. But in reality, the market kind of lives somewhere in the middle, right? So this is a really good post. There's a lot of wisdom to this post. So let's try to keep it simple, everybody. Good risk to reward ratio. Be patient. Wait for your setup. Follow your process. Rinse and repeat. Do that over and over every day for years, and you'll be surprised what happens. All right. So, okay, let's get on to the potential trades for next week. Now, I have 10 potential trades here on the daily time frame. Now, I say this every week, but listen, potentially Monday, for example, all 10 of these trades could trigger. Does that mean that I would take all 10 trades? No, it does not. I have a rule. I only take one trade per day. Even if I have 10 candidates, I'm going to narrow those 10 candidates down to the best trade. So how do I do that? Well, listen, this is what I teach my students. And by the way, I do teach private one-on-one lessons. I have a 20-hour course. It's a long course, I know, but you need a long course to really learn how to trade correctly. I teach my students all of the different trading approaches that I use, all the rules. We do a lot of simulation trading, and we have usually one call per week, and each lesson is 2 hours. So we have 10 lessons, 2 hours apiece. There's your 20. I love to teach. I think I'm a really good teacher. I have taught people from all over the world. I have turned out some really great traders. from absolute beginners all the way up to the hedge fund level and everywhere in between. So if you would like to be able to learn this skill of trading, I would be happy to be your coach. I would be happy to teach you, and I'll teach you everything I know. And I know when you're done with this course, you are going to have a lot of skills. You're going to have a lot of tools in your tool belt to be able to make money for the rest of your life if you follow exactly what I teach you. So if you're interested in it, my email is in the link of this YouTube description. Just send me an email. We can get the conversation started. It's a great course, everyone. Really, I have turned out some great traders, and I will do my best to turn you into one as well. As an alternative, I do have a really good online video course available at udemy.com. The link's in the description as well. And that course is just the deep dip buy stock trading strategy. And that's a great course. I've sold so many of them around the world. It's 9.5 hours of video, so there's a lot of content there. But whether or not you want to do the 20-hour one-on-one course with me, or buy that as a starter, either of them are really good. But I hope you do. I hope we can work together. And like I said, I think you'll be really, really glad that you did. But back to this. So I have 10 potential trades here. I need to narrow down the very best one if they happen on the same day. And that's what I was saying. That's what I teach my students, how to come up with the best trade, even if you have multiple candidates. And that comes down to which one has the highest quality score, which one had the most confluences. If one has an order block rejection, the other has an order block rejection and a rejection of the 200, which one's better? The one that has both, right? But then we also need to look at risk to reward ratio. I like to look at multiple time frames. I like to look at a higher time frame because perhaps that will give me a little bit more information of which one wins the contest with highest quality score, which one has the best relative strength. Relative strength just means if the market's down, but one of them is up in a down market day, that adds bonus points as well. All right. So I'm only going to take the very best one, the one that has the highest quality score. So let's start with Budweiser. Budweiser is interesting because we have a bullish order block within a bullish order block. The green box is the longer term order block. This happened all the way back here in April, but moving that into the future, it still holds weight. And you can see the order block happened here, back here in August. Where did it go before it bounced? To the bottom of the order block and then closed back in and then rallied for a month. All right. Well, now we are back into this bullish order block, the green order block. But interesting with order blocks, the green is the longer term order block. The blue is a more recent order block that's formed within the longer term order block. And so let me show you why. Look, we have a swing low here. We have a swing high here. We have a lower swing low here. And we change market structure here by taking out this swing low. Okay, so now that defines the order block. The lowest bar close before market structure change, the high and the low of that order block moved into the future is a buyable area. And you can see as soon as we change structure to the upside, look at this. Rejected the high of the order block. I didn't take that trade, but up from there. So I didn't take the trade, so what am I waiting for? I'm waiting for another move back down here to test the high of the order block or to test the low of the order block. Or if we lose this order block and then test the bottom of this order block, then I could get in there as well. But just right now, a rejection of the high of this order block, I would take that just based upon that without a moving average or anything in the middle because it's a narrow order block. So the high of that order block is 58.34. Next week, if we reject that high, I would consider taking that. Alternatively, if we rejected the low of this new order block at 57.77, I would also consider taking it there. Or if we reject the low of the longer term order block at 57.37, I would also consider taking it there. So a lot of different potentials. I think this is kind of an interesting setup because you have an order block within an existing order block. And to be honest with you, whenever I see these generally work when I see order blocks within order blocks. But who knows? Doesn't mean this one has to. But again, the high of the order block there, let's see. The high is 58.31, the low is 57.79. A rejection of either of those, I would consider taking that trade right there. Let's go to Walt Disney, DIS. Interesting. Everybody wanted Walt Disney. Nobody wants Walt Disney. But I don't know if we're going to get there, but I like this setup. We have a long-term order block from the past. What's living inside this order block now? Two major moving averages. The black line is the 200-day. The more narrow purple line at the bottom is the 250-day. These are both deep dip buy moving averages, the 200 and the 250. Just a rejection of the 200 is legitimate. Just a reject intraday or some type of rejection of the 200 or a rejection of the 250 is legitimate by itself. But what I like about this trade is that both of these moving averages are living inside of the bullish order block. And remember, that bullish order block, that's generally a buyable area. But having the major moving averages in the middle give me really good lines in the sand. So I'm going to be watching Disney carefully for rejection of the 200-day moving average next week or a rejection of the 250-day moving average. This is, I think, a very good risk-to-reward setup with multiple confluences. Doesn't mean either of them have to hold. Nothing is a for sure. But I like these areas very much because they give their confluences the support and they give very good risk to reward ratios using the major moving averages as your line in the sand. So that's what I'm looking for on Disney next week. Google, well, you've seen me talk about the bearish order blocks, and we have a bearish order block. Again, why? Here's a swing high, here's a swing low, here's a higher swing high. This day here on the 25th took out the swing low. That changes the market structure to the downside. If I change market structure to the downside, I want to short rallies back up into the bearish order block. So swing high, swing low, higher swing high, market structure change to the downside. That defines the order block, the highest up bar close here before market structure change. So this is the bearish order block area. We're not there yet. You can see here we got close and then rejected here. But if in the future we reject the bottom of this order block, that would be a potential short there, or clearly a rejection of the high of the order block would also be a legitimate entry. And the high of that order block is 256 even. The low of that order block is 251.84. So that's what I'm looking for, some kind of rejection of 251.81, the bottom of the order block, or rejection of the high of the order block, 256. My end of our stop on this trade would simply, if we closed above this high, that would nullify the order block. So that's what I'm looking for, potential short on Google. Home Depot. Everybody wanted Home Depot. Nobody wants Home Depot. So this is an interesting one. You've heard me talk about this before, but I have this mark down here. I have the 200 mark down here, and it's quite a ways down there still. It's 378.61. So it's down there a ways, but there is no order block. But again, just a rejection of the 200-day moving average by itself is legitimate. I like it better when it's in an order block. But the reason that I'm pointing this one out at the moment is, do you see the gray line here? This is the 50-day moving average. When the 50-day moving average closes over the 200-day moving average, that is called the golden cross. You've probably heard that. And that by itself is a long-term bullish signal. But what I have noticed in my experience is after you have the bullish cross, even though everybody thinks it's bullish, it usually comes down. That's exactly what happened. But the first rejection in my experience, what I found is the first rejection of the 200-day moving average after the cross is a very interesting and high probability trade. So we have had the cross. We have not had a rejection yet of the 200, but if Home Depot continues down further and rejects the 200, I would certainly consider taking that trade because, again, the first rejection of the 200-day moving average after the golden cross has happened is a high probability trade. So that's why I'm looking specifically for rejection of the 200-day moving average potentially next week. It's quite a long ways up. It may not get there. If it doesn't get there, I simply just don't take the trade and I go on to another trade that does get there. But if it does get there, that's a high probability trade with a good risk to reward ratio. All right, so that's what I'm looking for, some kind of rejection of the 200-week moving average next week, and we'll see what happens. Meta. So Meta really has been having a challenge here lately, clearly, right? We've been down straight for 2 weeks. So 2 different things going on here. We have an order block that it's coming into. So again, where's the order block? Swing low, swing high, lower swing low, market structure change. That defines the order block, the lowest bar close before market structure change. Move that into the future, and if you do come back into the order block, that's generally a buyable area. Let me try to put this in perspective. If you go back up to the highs up here, or the highs up here, and then you look back at the area where the order block is it safe to say that smart money was buying here? Again, this is in hindsight. This is if we're up here. Could you say that people that bought down here was smart money? Well, yeah, in hindsight, yes, obviously. If you're this high, the people that were buying there, that was smart money. So this means this was smart money here after the fact, after it moved up. But going into the future, is this going to be smart money again? It was back here. Is it going to be smart money again here? Maybe. I would contend that it's more likely than not, if you get back into the original smart money area, that it will be smart money again. Doesn't have to be, is not always. Things could change, right? Things are different now than they were back then, but more times than not, if you have a previous smart money area and you get back to that smart money area, more times than not, it's still smart money. So that's why I like order blocks. So now, when I was showing you on Coca-Cola, I was showing drawing the bottoms out into the future. Here's a swing low. Here's another swing low. You draw that out into the future. If the price comes down to this kind of megaphone trend line, generally there will be, and if you have a reaction there and you reject that megaphone trend line, generally that's a pretty decent entry point, just like I showed you on Coca-Cola. But we have 2 of these. Look, we have a swing low, draw it out. The trend line is right there in the middle of that bullish order block. We have another one. We have a swing low here. We have a swing low here. Draw those out. Do you see how they're both pointing into the bullish order block? So what do I do with this? Okay. Different ways we could approach this. If I reject the high of the order block, could I take it there? I could. I could potentially just take it there. My stop would, I guess, initially be a close below the low of this order block. It's a little wide for my tastes, but it's potential. The other option is if we go down further and we reject that trend line, meaning we go underneath it and close back above it, that could also be an entry point. And then my line in the sand would be a close below that trend line. We have this other trend line here. It's not as steep as this one, but again, if we go down and reject this second trend line and close back above it, that could also be an entry. So this one has a lot of possibilities, either a rejection of the high of the order block, a rejection of this particular trend line, a rejection of that particular trend line, or a rejection of the bottom of the order block, and the rejection of the low of that order block is 690.71. That would be my ideal. Now, one other. Look, we're a 3424 RSI. An under 30, over 30 RSI reading is a legitimate deep dip buy signal. Okay, that could also happen inside this order block. If I have an under 30, over 30 inside an order block, that's a totally legit. And that under 30, over 30 RSI may dovetail with one of these trend lines. So I don't know for sure, but there are a lot of potentials in this area on Meta next week that could potentially get me into this trade. So I'll be watching that very carefully. Netflix. Okay, so I was in Netflix. I got out of Netflix on the 1st of October. Why? If you remember, we closed below the order block. Okay, so that got me out of the trade. Now, there are multiple order blocks below. And speaking of trend line, look, here's a low, draw it out into the future. Thursday, it rejected that trend line, but then closed back above it. So there's a lot of potential here with Netflix. I would say a close back above this trend line would be one potential. A second would be a rejection of the bottom of the order block. That already happened on Friday, but I did not take the trade. So this one, it's a little tougher for me just to be exact because this is more of an objective trade, but just to kind of cover the bases, potentially a close above that trend line there, that's about 1156 would be one potential. A second potential would be another rejection of the bottom of the order block. That would be potential, or a rejection of this lower order block at 1131.06. So lots of different stuff here. We are coming into support levels, but we'll just have to see. I wish it could be a little bit more clear, but I'll know it when I see it. It's essentially what I'm talking about. But really, the first thing that I'm looking for would be a close above this trend line at about, it's kind of hard to say because it kind of moves. But again, I just had the bottom of this trend line, the bottom of this swing low, the bottom of this swing low, connected them out into the future. And so depending what it does on what day, it's going to be different. But right off the bat, if I have a close above that trend line right now, it's about 1150. Let's see, it's about 1157.77. That would be a potential for me. If we go down, reject the bottom of this order block, that would be another potential for me. So just have to see. But I think Netflix is on sale here, and it's in some interesting areas. And thirdly, look, we're at 34.23. So an under 30, over 30 is another potential if it heads down. Nike. All right, this one's a lot more simple than Netflix and Meta. We have an order block. We have a swing low followed by a swing high, followed by a lower swing low. Market structure change. Very easy to define this order block. Lowest bar close before market structure change. The high of this order block is 71.16. The low of the order block is 69.05. We move that into the future. Now, we have got several major moving averages inside the order block. First off here is the 250-day. Potentially take that with the rejection of the 250. The 250 is at 70.75. Another one would be the 100-day moving average that's living inside this order block. The 100 is 70.14. My favorite would be the 200. The 200 is 69.20 at the bottom of the order block. So I'll watch Netflix carefully next week for either a rejection of the 250 either a rejection of the 100 or a rejection of the 200-day moving average. This would be my ideal because it's the low of the order block and the 200-day moving average is very close to the low of that order block. So that would provide a good risk reward ratio. So we'll see. Maybe Netflix or Nike just takes off from here. I don't know. Big down bar on Friday, though. I wouldn't be surprised to have more downside. So this is the area with the rejection of the 250, 100, or 200. Palantir, okay, it's a good example of a market structure change that happened on Friday. Look, we have a swing low. I'm sorry, we have a swing high. We have a swing low. We have a higher swing high. And all we need to do is take out that swing low, and we've changed market structure to the downside. That happened on Friday. So as soon as this happened on Friday, now I know where my bearish order block is, the high and the low. The high of this is 188.20. The low is 182.95. It's a pretty narrow order block, bearish order block. So next week, if we come up and reject the bottom of the order block, 182.95, that would be a potential short. The rejection of the high of the order block, 188.20, would be another potential short. And then my end of our stop on this would simply be a close above the high of the order block, which is 188.20. So a good example of something that just changed market structure on Friday and looking for a check back and rejection into the bearish order block. Let's go to Philip Morris, PM. All right. Well, we have a nice bullish order block on PM on Philip Morris all the way back here on April 8th. Swing low, swing high, lower swing low, market structure change, smart money area into the future. Well, we're coming back into the smart money area. And what I am looking for is this 250-day moving average. And the 250 is at 149.38. That's living inside this order block. Interesting, I was showing you about the trend lines. Take the swing low, take another swing low, connect those out into the future, and look, to the penny on Friday is where the buyer stepped in at the confluence of those two swing lows, right? I didn't take the trade. To be honest with you, I didn't see this until last night. I may have taken the trade here. But really what I'm looking for would make the most sense to me, and the best risk to reward ratio and definitive line in the sand is this 200 rejection of this 250-day moving average. And again, that is at 149.38. All right, last one, VIX. VIX is interesting because VIX, we are in a bullish order block. Swing low, followed by a swing high, followed by a lower swing low, followed by a move up that takes out the swing high. That puts us into a bullish market structure that defines the order block. The high of the order block is 33.31. The low of the order block is 32.63. And I've drawn this out into the future. What I am looking for is potentially a rejection of the high of the order block and a close above it. But really what I ideally like to do on VIX would be a rejection of the low of this order block. And the low of the order block is 32.63. All right. Would be a very good risk reward ratio. The interesting thing about VIX is that for a long time, VIX has just gone straight down. Well, look what's happening now. For the last 2 weeks, really, it hasn't moved anywhere. It's been up, it's been down, but it's about the same price as it was 2 weeks ago. So VIX is forming some kind of base here. That, to me, is concerning for the market. And we have a bullish order block. And on top of this, look here at these lows here. These lows here have deep red MACD bars, or they have red MACD bars. Well, we are much lower here. The price is much lower here than it is over here. Would you agree? But even with that, we have no red MACD bars. That is called a double bottom with a bullish MACD divergence with a missing right shoulder. This, to me, looks very bullish. And conversely, if VIX looks bullish, that's bearish for the market. So keep that in mind. So again, just on the surface though, VIX has changed market structure to the upside. We have had a pullback, which is normal, but we're in a bullish area here. And so I'm looking for a rejection, either a rejection of the high of the order block for potential entry, or ideally a rejection of the low of the order block at 32.63. So we'd have to go under 32.63 and then close back in it. So anyway, that is what I'm looking for next week. I hope you enjoyed today's podcast. If you have any questions or comments, feel free to leave them in the comment section. I'll do my best to get back to you. If you need help with your trading, if you would like me to be your coach and do the 20-hour one-on-one course with me, I would love to have you as a student. I think the best way to learn anything is one-on-one with your instructor. So if that's of interest to you, just send me an email and we can get the conversation started. Like I said, I'll teach you everything I know, and I know when you're done with this class, with this course, you are going to be a much better trader. You have a lot of trades in your tool belt. But please enjoy the rest of your weekend. If you can, you have it in you, please try to go out, do one nice thing for another human being each day. It would make the world a better place. If you could go out, try to do one nice thing for an animal each day, if you have the opportunity to do that, they would appreciate it, just like we would appreciate it when someone does something nice for us. And you know, the world could use some kindness and some random act of kindness, right? So enjoy the rest of your weekend, everybody. Like I said, if you have questions, let me know. If you like today's podcast, please subscribe, or a thumbs up would be very much appreciated. And if you've made it all the way through, congratulations. I appreciate it. And enjoy the rest of your weekend, everybody. And God willing, I will see you next week. Thanks so much. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.